Hello, everybody, and welcome to the presentation. My name is Clay Malcolm here at Advanta IRA, and today I'm delighted to be joined by Jim Hiza at H3NRG, and he's going to be taking over the bulk of the presentation today and talk about oil and gas investment and the royalties that can be generated there and how that can work in your IRA is something that we're going to be discussing for the next little bit. From a housekeeping standpoint, we're delighted that you came today, and please do feel free to ask questions by typing them into the questions box in your console. We will be answering questions at the end. Jim is here. But he's not feeling 100% in terms of his health. So he's going to be coming on here in a minute, and we'll be giving his presentation and certainly be answering questions. But we are going to take them at the end so that we can kind of get through them all in one bunch. So please go ahead and type them in as they occur to you, and we'll get to them at the end. I'm going to start the presentation with a little bit about self-directed IRAs in general and how they can invest in oil and gas royalties. And then, like I say, I'm going to bring on Jim, and he's going to take us for the bulk of the time today, and then we'll do Q&A at the end. So once again, thank you everybody for joining us today. I know that your time is valuable, and we appreciate you spending some time with us and learning a little bit about how you can combine the tax advantages of your self-directed IRA with oil and gas investment. And that's a picture of me. My name is Clay Malcolm, again, here at Advanta IRA. And I've been in the self-directed IRA business since 2011. I've also been a self-directed IRA and HSA investor for that entire time as well. So not only am I an educator and a professional in the field, but I'm also an investor. So I'm one of you. And so a lot of what we do in our webinars here at Advanta IRA is try to bring on subject experts to teach us as investors things to look for when we're analyzing particular investments, what to be aware of in a particular asset class, things like that. So I'm always excited to have a special guest and to be able to learn some more about the self-directed IRA investing environment. You have my contact information there. I'm happy to be a long-term resource for you. I'm happy to answer questions about the account types, investment types, things like that, the mechanics. Anything that has to do with self-directed IRAs and their investment process, I'm happy to help you with. So if you aren't super familiar with all of the ins and outs of it, please do feel free to use me as a resource and contact me via phone or email. At Advanta IRA, we do not give tax, legal, or investment advice, and we certainly encourage you to utilize your professional team anytime that you are analyzing an investment for yourself, whether it's for your IRA or for you personally. So that could be your CPA, your attorney, friends and family, so on and so forth. We don't advocate any particular investment strategy or any particular investment vendor. We're actually a really neutral part of the equation. Our role is to provide the account and document the activity of the account so that it gets to keep the tax advantages, even though it's investing in a private investment. It's a little bit of a paradigm shift for a lot of people who have IRAs and 401ks. A lot of those instruments are only able to invest in publicly traded securities. And at Advanta IRA, we took the opposite approach and have our accounts have the ability to invest in pretty much everything that is allowed by law. So all kinds of hard assets and private assets like real estate, precious metals, cryptocurrency, things like that. So, and again, we are here to listen to what you want to invest in and help you accomplish that investment goal and attach the tax benefits of the account type to that investment. We're an interesting company in my view, in as much as we were created as a customer service organization. So everybody, every account holder that comes in gets an education and onboarding person like myself, as well as a dedicated account manager. They're your kind of back office person who is handling a lot of the nuts and bolts and the investment paperwork, any questions that you might have about your online portal, things like that. So you have that two-person team, you have our emails, you have our direct phone numbers, so you know who to talk to whenever you have a question about your account or if you want to make some moves. We are a medium-sized company in the space. We're about $1.8 billion in assets that we do the administration for. So we're big enough to have seen everything, but also small enough that you get phone numbers and emails, and you know who you're going to be talking to. So we try to make the experience a personal one, and I can say that from my experience as a self-directed IRA investor myself, that makes a big difference. To review a little bit, just to get down to the core elements of what we're going to be talking about today, I've mentioned a couple times that we're going to be combining tax advantages with particular investment returns. Today we're going to be focusing on oil and gas. But the idea is that any of these plans, these account types, traditional Roth, health savings accounts, some people are still unfamiliar with the fact that your health savings account can be an investor. HSAs are not flex spending accounts, so they're not use it or lose it. They persist through time, so they can do this type of investing as well. We handle SEPs and Simples. Those types of IRAs are employer accounts. We also handle education savings accounts and solo 401ks for those of you who are self-employed. And the most common strategy is somebody has an old IRA or an old 401k. And when I say old 401k, what I mean is that an employer where they no longer work. So it's automatically mobile, can be rolled over without tax and penalty. And they will take some or all that money and move it over to Advanta in order to execute a particular investment strategy. So again, today we're talking about oil and gas, but there's a myriad of things that are possible. All kinds of real estate, and what I mean by that is physical real estate. So your IRA can be by a residential property, commercial property, any of that type of thing. Also, any of the investment instruments that are associated with real estate, like tax liens, trust deeds, things like that. We handle private equity. We handle private lending. And today, of course, we're focusing on oil and gas, which is real estate related, even though the investment returns mechanism is slightly different than you might get from a single family rental property. And in the real estate space, we also do all kinds of variety of things. So oil and gas, agriculture, land speculation, raw land, all kinds of things that have to do with real estate. So, and we're also, seeing more and more cryptocurrency. We do cryptocurrency and things like that as well as precious metals that you see there. So any of these investment strategies they have is in terms of these asset classes that have the ability to be combined with the tax advantages of the account type. You just have to have it at a self-directed IRA provider like Advanta. And one of the things that I most enjoy about self-directed IRA investing is I get to use my existing financial team and structure. So yes, in this paradigm, the account holder is the motive force, right? You as the account holder decide what the investment is going to be. You do the negotiation of the terms, but you don't have to do that alone. You can use your professional team to help you do that, whether that's a trusted real estate professional or a CPA, financial advisor, attorney, any of those folks. So yes, the motive force and the decision making is a part and parcel to being the account holder. But again, you don't have to do it alone. You get to bring your team with you. And I think that makes the process one that's much more comfortable and familiar with folks. And in fact, self-directed IRA investing, one of its great advantages is that you get to invest in things that you actually have some understanding of. And the knowledge and expertise that you and your team have, you can bring those to bear to generate money for your retirement account. And it's a relatively easy process, and this is going to be my last slide before I turn it over to Jim. A lot of people think that it's going to be very complex or time consuming to get a self-directed IRA open to invest, and it's really not the case. It's a process where you would open up an account. That really, the application is mostly personal information, it takes about 10 or 15 minutes. I can have the account open in a business day, and then we start working on moving money into that account, and that can be any one of a number of things. It could be a transfer from another IRA. It could be a rollover from an old 401k or 457, 403b, 401a, thrift savings plan. Almost all those retirement accounts are mobile once you've separated from employment. So that means that they can be rolled over without tax and without penalty. And you can also make contributions if you're eligible to do so for that particular account type. So we opened up the account, so it gives the money a place to go. We move the money in via transfer, rollover, and contribution. While it's in cash, it's FDIC insured at a bank, awaiting its investment instructions. And then you are pursuing the investment that you would like, letting us know about it, and then we help you assemble the paperwork that documents the fact that it is the IRA making this investment. And then on the day that you specify, we will send cash out of your IRA to close the investment. And then, of course, the investment returns come right back into your IRA's cash position. And we record that, and thus you get to keep the tax advantages, or the tax advantages attached to that money that was just earned. And so, but the account is actually operating just like any other IRA or 401k that you've had before. It's just that the assets that you're going to purchase are a little bit different. And getting that strategy into place, relatively quick process. Not uncommon for us to have somebody have an account open and invest in a week, or a week and a couple of days. Sometimes it takes a little bit longer, but it's a relatively quick process. So if you would like more information about that, I'm going to be your person for that. Happy to help you at any point, give you some education, and talk about what your investment goals are. And speaking of investment goals, I'm going to go ahead and bring Jim Hiza on now. So Jim is with H3 NRG, and he has both a financial background as well as a oil and gas background. And so we're lucky enough to have Jim join us today. Again, even though he's feeling a little bit under the weather, I think he's going to power through. So Jim, are you there and ready to go?
Yeah, thanks, Clay. Hey, everyone, I apologize in advance for the coughing and sniffling as I get through this. So today, we're going to talk about oil and gas royalties and what they are, and the benefits and features of the asset class. So quick background on myself. Personally, I was a CPA out of college, quickly went into financial advising and was a registered investment advisor for almost 15 years. Until after the financial crisis in 08-09, when I got my clients' money back, was searching for alternative investments and found oil and gas royalties. Thought so highly of the asset that I subsequently sold my practice and went into the business. Ended up managing and brokering royalties for hedge funds, endowments, institutional investors, large high net worth investors, etc. So personally, I've got 12 years experience. I've owned royalties personally, still do. Our team has almost 50 years experience and hundreds of millions of dollars of acquisition experience throughout the basins, all the different basins in the country. So with that said, the difference between minerals and royalties, just so we know what we're talking about here. Minerals are the subsurface real property interest granted to the ownership of not only oil and natural gas, it could be coal, lithium, cobalt, whatever the minerals are in that area. So it's the subsurface real estate owner, which is different from, it could be different from the surface owner. The U.S. is unique in that way, where the surface and subsurface owners can be severed and can be different people. Many countries, the governments own the minerals, but not here in the U.S. So what turns a mineral into a royalty is when the mineral rights are leased, the owner will retain, per the lease, a royalty to receive a percentage of the production in the form of monthly cash flow from the operator. And this doesn't apply to IRAs and Roth IRAs or any of the qualified plans, but if you happen to own royalties outside of a qualified plan, they do receive a 15% depletion allowance from the tax perspective. Okay, again, just to quickly summarize, surface ownership, you've got the right to develop, sell, transfer land, etc. But the mineral rights ownership, what that means by their dominant to surface rights is, let's say they're different people. If I own the mineral rights and Clay owns the surface rights, and the oil and gas company negotiates a lease with me, the mineral rights owner, to drill a well on Clay's farm, then we don't need Clay's permission to do so. However, having said that, there are certain protections for Clay. He is a surface rights owner. There's protections in terms of how close to any living facility, a house, they can put the well, but also he is compensated for the couple of acres that they're going to use to build the well pad. Being real property, they do qualify for 1031 exchanges under the IRS rules. So real quick, working interest in royalties. So royalties are passive income. Working interest is the operator, is the owner of the well itself. They operate the well. It could be Exxon. It could be, there's lots of companies. It could be Chevron, any of those companies that drill wells. They own the well. They have to pay for all the cost of drilling the well. They have to pay for all the upkeep of that well. They have to, they're on the hook for any, damages if the well breaks or they mess something up and they cause some environmental damage. They're on the hook for that. The royalty owner is not. You are completely passive and you are the first to be paid. Even if the oil and gas company goes bankrupt, it's no different than, say, if Walmart, for whatever reason, took on a bunch of debt and went bankrupt, the stock goes to zero, but the Walmart stores stay open. Similar thing here, the oil and gas company goes bankrupt, but the pumps keep pumping. Royalty owners keep getting paid. I personally have owned royalties where two companies have gone bankrupt, and I never missed a check. That's standard. To turn the wells off and turn them back on messes up the integrity of the well, so they don't do that. The other advantage for the royalty owner is you get dual organic growth. First, from commodity price increases, and second, from reservoir development. And we're going to get into reservoir development and how that can really help in just a minute. But when you think about your royalty check, it is a simple math. It is how much oil and gas is produced times the price of the commodity times your ownership interest. That's your check every month. So if the production goes up or down, or if the commodity price goes up or down, typically the commodity prices go up over time, then you get some growth in the cash flow. It is the surest form of security in the oil industry. You've got monthly cash flow. If you think back to, for those that are old enough to remember the Beverly Hillbillies, that is oil and gas royalties, where they're collecting monthly cash flow or mailbox money. So organic growth through reservoir development. In many of the geological formations around the country, there are multiple layers underneath the surface of the earth, so that they can drill into and produce oil or gas. Oftentimes, when we're looking at royalties, they've drilled one of those formations, and many of them have 5 to 7 to 9 layers of different formations they can go back in and drill. And they will do so when it's economically feasible. So there is upside from that perspective. Also, when you own minerals and royalties, you have an acreage, and they know, based on the reservoir, how far apart they can space wells before those wells start interfering with each other. So oftentimes they'll drill a well in the same zone, but just on a different part of the acreage. You get a royalty check from that well. You don't have to pay any of the cost of drilling the well. So there's upside from that perspective as well. That's the dual organic growth component. Excuse me, of the asset. Additionally, the length or extending the life of the well. Most wells, when they're drilled and you have them engineered by a petroleum engineer, you'll see that they're going to last anywhere from 30 to 50 years. And we know that in the first phase, typically the pressure of the reservoir is high, so the production comes out pretty strong, and then it starts to taper off. It actually drops pretty good the first 2 years, and then it's a slow decline for decades. We have the technology to go back in to the same wells by injecting water or CO2 to increase that pressure and recover a little bit more of the hydrocarbons. And after that's done, typically only about 30% of the reservoir has been recovered. And so they can go back in again and do what's known as enhanced oil recovery to try to reverse the decline of those mature fields Every time they do this, it does extend the life of the well. There are wells still producing today that are over 100 years old. So this is multi-generational cash flow. Okay, we definitely need to talk about the current climate in terms of net zero and what that means for oil and gas and the push for alternative renewable energy, solar, wind, etc. So net zero, really what that means is they are looking to offset the carbon that's produced, not necessarily reduce the carbon that's produced. So if you're a company that manufactures fertilizer and you burn a lot of natural gas, and so the CO2 that you are emitting into the air, you have to do something to offset that on paper. That's what net zero means. It does not mean you have to stop producing fertilizer. So let's think about all this push with the raw materials that will fuel this renewable energy. It takes a lot of metals. You know, you've got cobalt and graphite and lithium and zinc and copper, etc., to produce the motors for electric vehicles, the batteries, the hardware, the wiring, solar panels, as well as wind turbines. It's going to take a lot of metals. So if you look at what the World Energy Outlook for 2021 is estimating by 2050, which is where the net zero targets are, we're looking at increasing the battery storage by 50 times, doubling the demand for copper, and we see lithium demand going up 100 times its current level. Not 100%, 100 times. And then you look at nickel and cobalt, their demand is estimated to go up 40 times. So we ask the question, is this sustainable development? You know, a recent geological survey from some geologists in Finland estimated, the chart on your screen here, as you look at cobalt, copper, nickel, cobalt, lithium, and graphite, based on 2018's production, to switch to the entire automobile fleet to electric vehicles, as well as wind and storage to power the electric grid. Nickel, for example, we need 422 million tons, which, you know, we only produced 2.3 in 2018. So we need basically 183 years worth of 2018's production. Lithium, we need 700 plus years worth. And the percentage of the global reserves is more than we know that exists by a long shot. So in essence, you know, we're saying, okay, we definitely need wind and solar and electric vehicles, and we need to conserve energy, but it's not going to displace the oil and gas industry. Not to mention the dependence on foreign sources for these metals and minerals, and definitely dependent on China for processing them. Which begs the questions, you know, is the supply of these minerals and metals unlimited? No. How are they produced? Most of them are strip mined. And where's all the money going to come from to build all this out? Which leads us right back to, you know, oil and gas is here to stay for a long, long time. Not to mention there's some 6,000 products that are produced from petroleum, you know, from plastics and cars and toys and computers and clothing and road construction and just about everything in a hospital room, fertilizer, herbicides, pesticides, etc. Recent headlines with oil prices, as you can see at the bottom of the screen, they were up about 62% last year, natural gas about 38%, with many of the big investment banks predicting $100+ oil this year and or next. And it just makes sense with the push to curtail production from the policy decision makers as well as the banks under ESG, but yet demand isn't going anywhere. You've got, you know, rising demand and a slowly rising demand and falling supply, so prices are going to go higher. With that being said, us here at H3 NRG, Natural Resource Group, we are not a fund. We are not a Reg D offering. We don't charge management fees. We essentially broker the transaction of deeded title real property. So you would invest directly. You would get a copy of the deed. Right now, we can generate deals that produce somewhere between 10 and 15% initially. And that's based on the previous 3 to 6 months cash flow from the sellers. Obviously, as going forward, as I mentioned earlier, that will change monthly depending on the prices and the production. Minimum investment is $50K. My contact information is here. I guess, Clay, with that, we will open it up for questions.
Okay. Thank you, Jim. I appreciate you.
Sorry for all the hacking.
I appreciate you powering through. And we do have a few questions, so I'm going to go ahead and get into these. I'm also going to put yours and my contact information up on the screen.
Okay.
For those of you in the audience, if you do have questions, this is a great time to type them in the questions box, and we'll get to those if we can. And we're going to go ahead and launch into those at the moment. So the first one I have here, Jim, is given what you've said about and I'm paraphrasing here, given what you said about the mineral rights and the royalties that those mineral rights can generate, why do folks sell them? How do they come on the market? How does that work?
Yeah, great question. We get that. Everybody asks that because it is such a phenomenal asset. Why would you ever sell it? Typically, the two main reasons we see sellers selling. One is estate planning. So, somebody in the family owned them, they passed them down to the next generation, and the next generation just wants to cash out. We see that all the time. Additionally, when other sellers are in the market, they are only selling a small piece of the royalty portfolio that they have. I would say the third reason is you've got some people that like certain aspects of the royalties. For example, they like to buy unproducing mineral rights before there's ever a well drilled. Once the well's drilled, it doesn't excite them anymore, so they typically will sell and go do it again.
Okay, interesting. One of the questions in the box is the royalty 10 to 15% per month or per year?
That's annualized.
Annualized, okay. And just
I wish it was monthly.
There's another question here. I'm going to paraphrase this one too, but I think the gist of it is, how does H3 NRG make money? What's the revenue stream there?
Yeah, good question. So we have, think about a real estate broker. They'll have multiple listings on file or in inventory all the time. We have about $20 to $30 million of deals in inventory every month. We see that much deal flow. We will have them under contract. We will typically just put a little markup on them and sell them to you, to the investor. So we just make a little spread. That's it as a brokering transaction.
Got it. Next question is, what are the term limits for the royalties?
Good question. The royalties will be produced as long as the wells produce. So again, going back to the engineering, the typical wells will last 30 to 50 years without them going back in and stimulating production the second time and the third time, without them going into the deeper reservoirs. There might be 7 different reservoirs underneath the earth. You're only in one. So they can go into reservoir 2, 3, 4, 5, 6, and 7 without them drilling new wells on the acreage. So multi-generational.
And this is a question asked by somebody else in the audience, but it's kind of related to. So does the investment fluctuate in value? And I know that you touched a little bit on this, but could you say go back into that a little bit?
Yeah, it will fluctuate in value. we like to keep it simple. We like to value royalties based on a multiple of cash flow. And so what we saw in 2014 when oil prices ran up to 140 bucks, we saw that multiple get larger. So the value of the assets got larger and the yields got lower. Subsequently, in 2015, when oil prices crashed back down to 40, we had the reverse effect. So yes, the value will fluctuate with the cash flow, but it's like a house. You don't know what the market value is until you put it on the market.
And got it. And here's two more questions. I'm combining a lot of these because they have a certain theme to it. So,
Sure.
tell is there a typical life cycle for the investment in terms of how long you keep it? Is there a minimum or maximum? And if you want to get out, can you? What's the ability to get out of it if you wanted to?
Yeah, good question. There is no typical life cycle. It really is an individual choice and depends on your individual circumstances. In terms of selling, it is deeded title real estate. So there are a couple of auction firms that you could sell through. We also, however, are talking to investors on a monthly basis. We could be an outlet for you. It's not 3 days later you get your money like a stock, but you can certainly liquidate and get out within typically a couple of months.
Got it.
And Clay, I do want to add one more point to that.
Yeah.
We are connected to all of the intermediaries for the 1031 exchange market. And so they call us all the time to see if we've got anything that can fill the gap. So when you're selling one capital asset for say $1 million and you've got a gain, let's say your gain is $1 million, you're selling it for $1.5 million, and you're buying another capital asset, but it's only going to cost you $1.1 million. So you've got that $400,000 gap there that you're going to pay taxes on. So they'll often call us and say, hey, do you have $400,000 worth of royalties that we can use for this investor to fill the gap and avoid, keep deferring the capital gains. So we have that as an outlet as well.
And so even if it were my IRA that owned it, the ability for and the desire for an investor who's a personal investor to buy, let's say my IRA wanted to get out of the investment that it had, that 1031 ability is bringing more buyers to the table, so to speak. Is that correct?
Correct.
Okay. In terms of mineral rights, this is a question from the audience as well. Can we specify the limit, the types of metals? So in other words, can you buy mineral rights for specific minerals? Is that a possibility in the United States?
I would presume so. I'm not an expert in that, but subsurface deeded title real estate goes to the core of the earth. So I would imagine, I know there are for coal. I know there's minerals for coal. I would presume there is for all these other metals.
Interesting. But can you buy that? Do you know if you can buy them individually, like buy the mineral rights?
I don't know. Yeah, I don't know. I do know that we're starting to see a secondary market for royalties in solar farms and wind farms. That is starting to pop up. We are seeing that. Now that's on the surface. That's not minerals, but we are starting to see royalties from that.
So next question. If I understand correctly, royalties are only paid if the well actually produces. Is this correct? And if so, is there a percentage of how many wells actually produce and pay out?
That is correct. Produce and pay out, meaning produce cash flow. I can tell you that ever since we started horizontal drilling, the number of dry holes has gone to virtually zero. There are still some. Sometimes the geology just it doesn't work, and they mess something up, the operator messes something up and breaks the well. But otherwise, dry holes are rare these days, and the reason is when you look at an MRI of the Earth, we call it it's 3D seismic. It's not one giant lake of oil and gas; it's pockets. And so when they were only drilling vertically, you could miss one of those pockets very easily. I think the miss rate was about 50%, making it extremely risky from an investment perspective. But now going sideways, you're hitting all of those pockets as you go sideways. So the likelihood of a dry hole is very small. And again, we only deal with royalties that are already producing. The wells are already producing. They've been online for years.
And so, we were talking about this, as we were kind of chatting and setting up, that there are ways to venture into this asset class and not do well. So
yeah,
what are some of the things that people would need to consider that they might want to consider staying away from, or just kind of decision points that are key?
Sure. So yeah, Clay and I were chatting briefly. Royalties or minerals can run the risk spectrum. Where we play in is the conservative end. We know the wells exist. We know they're producing. We've got the seller's check stubs, and we know that they are the true owners because the operator doesn't pay any royalty owner until they do a complete title search. So anyways, having said that, the opposite end, if you're buying minerals that are not producing, there's no guarantee they ever will produce. Maybe there's oil and gas underneath the minerals, but the pocket is so thin they're never going to drill a well. Or maybe it's on the very fringe and you need $300 oil before it makes economic sense for them to drill a well. So when you're buying non-producing minerals, you have no control over what the oil and gas operator does and when they drill a well. So you're just waiting and hoping. On the other hand, minerals can be divided themselves. They are the subsurface rights, but they can be divided by depth. So if you're not careful and you acquire minerals down to 2,000 feet, but all the reservoirs where oil and gas can be produced are below that, then you're never going to get any production. Additionally, if you don't check and see that you are basically getting minerals and royalties on an acreage basis versus a well basis, you could own royalties what's called on a wellbore only, meaning the existing wells as they are. If the operator drills another well and you own wellbore only royalties, you do not get a royalty on the new well because you don't own the acreage. So you've got to be careful. Those would be the two main things I would say you want to look for. We at our company, we don't deal with either of those. We always deal with all depths and we always deal with acreage. We never touch wellbore only.
So here's a couple of questions that are a little bit outside of the IRA world, which is totally fine. So, but one of them deals with 1031 exchanges, and I have some knowledge of it, but I think it mostly just makes me dangerous instead of helpful. So I'll ask and see if you have something to do here. So at 1031, do 1031 exchanges have to be similar types of assets, or can you say, if you made a profit on an industrial building, can you then, funnel those via 1031 exchange to oil and gas royalties?
The answer to the question is they do not have to be the same. They just have to be a capital asset under the IRS definitions.
Gotcha. So it doesn't have to be apartment building to apartment building or any of that kind of
Correct.
thing. Okay.
Correct.
And then and this question you may have I think I saw a little bit of something on this. So they're talking about using non-IRA money. Are there tax advantages for royalties that you would have as a personal investor rather than just an IRA investor?
Yes. So when you own a building, the IRS says you get to depreciate that building, right? You get to take a percentage of the building every year and expense it, which reduces your current income, especially if you're renting the building, right? Same thing with royalties and minerals. It's called depletion, not depreciation. There are two methods of depletion that the IRS allows. One is called cost depletion. You have to hire a petroleum engineer to figure that out, which is expensive. And once your basis gets written down to zero, you can no longer use the cost depletion. The IRS does allow for a straight 15% depletion, and you can use that even if your cost basis is zero. So you can use it forever. And you don't need an engineer to figure it out. You can just take 15%. If you made $100,000 in royalties on your federal tax return, you're only going to pay taxes on the first $85,000.
Got it. So since we're talking about money and taxes and stuff, somebody asked, what does Advanta charge for an investment scenario like this? And our fee schedule is basically based on our fee for service, so our bookkeeping labor, for lack of a better way to put it. And so in an investment like this, it would be $50 to open the account. There'd be a $95 transaction fee when we process the investment itself, put it onto our books, and that applies at sale too, or the conclusion of the asset. So if you ever decided to sell it or things like that, or if you distributed it to yourself, so there would be a charge there, and that would be $95 to take it off the books. Now that might be years from now or decades from now or whatever, but $95 at the beginning, $95 at the end. And then in the intervening years, there is an annual fee that we charge, and for an investment over $30,000, it would be on our flat annual fee schedule, which is $295 a year. And we do charge for incoming and outgoing wires and little things like that. So I would say that it'd probably be to set it up the first year and get into the investment. It'd be $500 that first year, and then $295 a year for all the years when it's just kind of operating and you're collecting the returns, and then another $95 added on the end when we take it off the books. So there's a sketch of that, and our full fee schedule is on the website, and I'm happy to send you one if you're interested. And then
I do want to add something, Clay,
yeah.
before the last question.
Yeah.
Buying royalties is a process. And I think we just need to lay that out for everybody just so they can have an understanding. When you execute the contract and wire the money, then deeds get signed and get recorded at the respective county courthouses. You sign them, you get a copy of them. You get a copy of the recorded deed. We then file that with the operator and copy you on the email, letting them know that, hey, there's been a change in ownership. That way you have direct access to the contact person at the oil and gas operator. The next phase is the operator will then put those royalties into what's called suspense. They basically go into a trust fund while their attorneys do the legal title review to make sure, yes, this did change hands, and yes, here's the ownership percentage. Once they complete that process, you will get typically it's what's called a division order. Sometimes they'll call it a deck that will list all the wells on your acreage. It will list your ownership percentage. You sign those, send them back to the operator, and then you start getting your monthly checks. We are currently being quoted from many operators that this process is taking 6 to 8 months because they are short title attorneys and staff. We will walk you through the entire process, and we are here to guide you and answer questions along the way. But just know that this is a process. You're not going to get royalty checks right away.
Got it. Yeah.
However, having said that, if you acquire royalties from February 1st, and let's say it's September when you get your first check, you will get all of those back royalties to February 1st.
Interesting. Okay. So we got a couple more questions coming in there, so it might not be the last, and they're good ones. So I want to get into it. So there's a question about, in your IRA, are you able to use that depletion in some way? And the answer, typically speaking, is no.
Correct.
IRAs are
The income's tax deferred anyways.
right. So you already have the tax deferral, so you don't really need the depletion allowance. And so it's a good question. I get that a lot with other types of real estate. So I appreciate the question, but
Yeah.
It's not
The
really necessary.
income in your IRA, the royalty income will not go on your tax return.
Right. And I talk to folks about this a lot too. It's, if you don't make a contribution or take a distribution or do a traditional to Roth conversion, in any given tax year, your IRA could make $1 million or lose $1 million. It wouldn't affect your personal tax world one bit. So it's got its own rules going over there.
Right.
Okay. So next one is deed register is it taxed at the county as property tax? And if so, who pays that?
Good question. Yes, there are ad valorem taxes. There are property taxes to be paid. Some operators deduct it out of your royalty check, depending on what state you're in. Other states, you get a bill. And you pay it. The property owner pays it.
Right. And in the case of an IRA, that would be the IRA that pays it. So
correct.
Yeah. Okay. Last question. And Jim, I really appreciate you hanging in. I can tell that you don't feel great. So the last one is really just about area. So, and specifically the question was asked about, can you buy mineral rights in foreign countries? But I guess I'm going to expand that to, where does this kind of acquisition occur in the United States, and can you do it foreign if you wanted to?
Yeah, I know Canada has royalties. We don't know how to do it. It's not our area of expertise. I'm not aware of any other country that does it. Maybe Australia, but I'm not sure. Otherwise, all the other countries, the governments own the minerals and royalties. In the U.S., if you just do a Google search, you'll find the major reservoirs. You've got West Texas, you've got East Texas, you've got Louisiana, the Haynesville, the Permian's West Texas. You've got Oklahoma with the Mid-Con. You've got the DJ Basin in Oklahoma and Wyoming. You've got Appalachia, which would be West Virginia, Pennsylvania, some in Ohio. But many other states aren't in a major reservoir, also have producing oil and gas. California does, Utah, Illinois, Kentucky. They're all over the place.
Interesting. Well, Jim, I'm going to go ahead and wrap this up. If there's any questions that are coming in now and I don't see them, we will get you an answer. So don't worry about that. You have our contact information there on the screen, and both Jim and I are happy to answer questions as they occur to you in the upcoming days and weeks and things like that. So please do feel free to reach out. I'm going to go ahead and say my thanks once again for everybody for spending some time with us today. I appreciate that you've given us the opportunity to talk to you a little bit about something that I hope will be helpful for you in terms of your investment strategy. And Jim, any parting thoughts for you?
No, just thank you, everyone, and thank you, Clay. If you've got questions in the next 48 hours, if you would please email them, because my voice isn't going to stand up. Thank you.
All right. Well, thanks, everybody. Have a great day. Be safe, be well, and happy investing. We'll see you on the next one.
Take care.